Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now, over the past week, there's been a continued focus on Trump's nominations for his future cabinet, and the big one in recent days was the announcement of his Treasury Secretary candidate. Financial markets have also moved considerably since he started announcing his preferred candidates. So the big question for markets, of course, is, are all the worries and optimism now in the price, or do we still have some opportunities? To discuss this and more, I'm happy to join today by Fook Hien, who's a senior investment strategist in the CIO office. So welcome, Fook Hien. Thanks for joining us today. So Scott Bessent, he's been nominated as the future US Treasury Secretary, and he seems to have a perception of being business friendly. Could you help maybe our listeners understand why that is the case and what exactly Scott Bessent has meant by his 3 arrows proposal?
Yeah, hi, Manpreet. So, yes, Trump's Treasury Secretary pick, Scott Bessent, he is a veteran on Wall Street. He is a career fund manager who once headed the iconic hedge fund manager George Soros's family office. Given this background, Bessent's policy outlook is likely to be less ideologically driven and more based on economic outcomes. So during the election campaign, Bessent referred to former Japanese Prime Minister Shinzo Abe's 3 arrows reflationary policies in the context of the US. So Bessent's aim is 1, to lift US growth to 3% from around 2% through tax cuts, deregulation, reshoring of manufacturing jobs through strategic protectionism, and by lowering energy costs. And 2, he wants to cut the energy costs and reduce inflation expectations by boosting US oil and gas output by 3 million barrels of oil equivalent per day. And this is through deregulation and making more land available for drilling. And the 3rd arrow is to cut the US budget deficit to 3% of GDP by the end of Trump's 4-year term from over 6% this year. And to do this by lifting economic growth and cutting wasteful government spending. So Bessent's arguably aspirational agenda is based on gradualism. For instance, he has advised using tariffs as strategic negotiating tools by imposing them in tranches, tying them with set objectives that US trade partners will have to meet. He has also warned against cutting Medicare and Social Security payments and instead to focus on freezing discretionary non-defense spending to reduce government expenditure to pay for the tax cuts. So Bessent's proposed non-inflationary growth agenda would help explain why bond yields fell this week following his nomination. We would use any rebound in the US 10-year government bond yields towards 4.5% to lock in income over the longer term. But Bessent's pro-growth policies are also likely to sustain the US expansion. We remain bullish on US equities over 6 to 12 months. However, US investor positioning is stretched according to Vanda research data. We would use any near-term pullbacks to average into US equities and our preferred sectors there.
Thanks, Fook Hien. Let's dig into that conversation on US equities a little further. US stock markets, of course, made a record high again this week. So in your view, are US markets likely to hold up better than Asian equities amid Trump's tariff threats? How do those tariffs impact US equity sectors? And what are your preferences there?
Yeah, so Trump's plans of raising import tariffs, they triggered a broad market sell-off across Asia lately, with the MSCI Asia Japan Index falling by over 9% from its October high. While potential supportive measures in the Asian region may help mitigate the tariff impact, we are inclined to switch into the US, which is our overweight region within equities. The sectors with higher domestic revenue exposure should be more insulated from tariff impacts. For instance, the financial sector would be more insulated from US tariff policy and any potential retaliatory actions. US small caps are also set to benefit from rising US protectionism and pro-growth policies. In contrast, we expect a near-term headwinds in areas such as automobiles amid the threats of a 25% tariff on Mexico and China and Canada's import to the US. So in addition, sectors such as technology, materials, and energy, they have high revenue exposure outside of the US, and they could be vulnerable to any further trade tensions. That said, we believe a strong pricing power and robust demand for the higher-end US exports will likely mitigate the impact of any future retaliation. So we favor sectors such as technology and communication services despite its higher non-US revenue share due to the ongoing artificial intelligence megatrends and strong earnings growth. These sectors, they produce goods that cannot be easily replicated or replaced, and we would view any near-term retreat in technology and communication services as an opportunity to add exposure.
All right, let's maybe shift gears a bit and go to China. In your view, how should investors be positioning themselves in Chinese equities ahead of the Central Economic Work Conference meeting? That's coming up.
Yeah, US policies like tariffs are likely to have limited direct impact on China equities earnings, given they generate most of their income domestically. So 87% of MSCI China revenue is generated domestically. However, the indirect impact on consumer and business sentiment, as well as access to technology or supply chains, these are likely to impact Chinese equities. To offset these, we expect the Chinese policymakers to roll out more stimulus, with details possibly forthcoming at the Central Economic Work Conference in December. However, we believe policymakers in China, they may prefer to calibrate the size of any stimulus after US policy details are unveiled, which is likely only after Trump's inauguration. Furthermore, China is unlikely to roll out a negotiated outcome with the Trump administration. In the meantime, we prefer a barbell strategy in China with our buy views on, firstly, the non-financial high-dividend SOEs for income stability amidst the uncertainty. We focus on non-financials subsector, which are less exposed to the troubled property sector. And secondly, in this barbell, the Hang Seng technology sector for a valuation re-rating when more policy stimulus is rolled out. Companies in these sectors, they also generate strong cash flows, which are used for share buybacks. So this barbell approach would provide exposure to income stability along with higher beta gains when China unveils more stimulus.
All right, and finally, currency markets. In your view, what's the impact of everything we've learned about Trump's proposed policy agenda on commodity currencies like the Aussie and the Canadian dollar?
Yeah, Trump's protectionist trade policies and the resilient US economic fundamentals, they have created volatility for the commodity currencies. Oil and gas and energy products, they are Canada's primary exports to the US, which alongside automobiles could be most impacted by US tariffs. In this scenario, Canada's trade balance is likely to suffer and have a negative impact on the Canadian dollar. So any global trade slowdown or trade-induced economic drag could also suppress the demand for oil, indirectly weighing on the Canadian dollar. We believe the US dollar to the Canadian dollar is likely to rebound towards resistance at the 1.418 in the short term. Meanwhile, Australia's economy is heavily reliant on Chinese demand for commodities like iron ore and coal. So heightened US-China trade tensions, it could dampen Chinese economic growth and reduce demand for Australian exports. However, any compensatory Chinese stimulus plans could help to limit this risk. Australia's core inflation also climbed back to 3.5% year on year, and the RBA cuts are not expected before May 2025. We expect these factors to help the Aussie dollar to the US dollar rebound towards 0.669. But we do prefer to express our view on the stronger Aussie dollar by being bullish the Aussie to the Canadian dollar, targeting the next resistance at 0.94.
Okay, well, thanks, Fook Hien. I think we're just about approaching the end of time, so we'll bring the conversation to a close there. As always, if I can highlight some of the key takeaways from our conversation today. First up, U.S. equities, of course, potentially still the biggest beneficiary amid Trump's proposed agenda, particularly domestic sectors like financials, but we'd more look to average in on pullbacks given where positioning is today. Second, in Chinese equities, we still, of course, like non-financial high-dividend SOEs and Hang Seng technology sectors, both, of course, maintaining a domestic focus. And finally, the currency market opportunity we see is in the Aussie Canadian dollar pair, given the divergence, particularly between a hawkish RBA and, of course, tariff worries for the Canadian dollar. So thanks, Fook Hien, for taking the time to join us today. Thank you, listeners, for joining us in today's conversation. We hope you enjoyed that conversation, found it insightful, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.